Over the last few days, there has been a sudden spike in panic around Schedule FA. People are receiving emails, notices, nudges, and suddenly LinkedIn, WhatsApp, newspapers, everyone is talking about it. And the first reaction is obvious. Is this something new? Is this unfair? Why is this happening now? Before jumping to conclusions, let's slow down and understand what is actually going on. Everything in Indian taxation starts with one simple concept, the concept of residential status. Under Indian tax laws, you are classified as either a non-resident or a resident. But within resident classification are two subcategories. One is a resident but not ordinarily resident, which is a special status to returning NRIs to be able to realign their foreign assets. Or the second subclassification is resident and ordinarily resident, someone who lives in India. Taxability follows residential status. Disclosure obligations also follow residential status. If we don't get this step right, nothing else will make sense to you. So if you're a non-resident, your foreign income is not taxable in India. Because it is not taxable, your foreign assets are also not required to be disclosed. The income tax return instructions are very clear. Schedule FA need not be filed for non-residents. So for non-resident taxpayers, Schedule FA is simply not applicable. Now coming to the RNOR status. For RNORs, limited foreign income can be taxable in certain special situations, like business income being operated from India. Apart from that, the global income is not taxable in India for RNORs. Remember, RNOR is a special category for realigning your assets. Therefore, Schedule FA still does not apply because your global income is not taxable. Now, Schedule FA becomes relevant only when you are a resident and ordinarily resident. So, if suppose you have come back to India after 2-3 years, your RNOR status is also expired, then you become a ROR. At this stage, your global income becomes taxable in India, and India expects visibility of your foreign assets and financial interests. That is where Schedule FA comes in. Let's understand what Schedule FA really is. Schedule FA is often misunderstood. It is not a tax calculation schedule. It is a disclosure schedule. Its purpose is very simple: to disclose what foreign assets and interests you hold. You can have disclosure even when there is no additional tax. Tax payment and disclosure are two separate responsibilities. So why Schedule FA feels harsher than other disclosures? This is where many people feel uncomfortable. Domestic assets are disclosed under Schedule AL, and that applies only if your income crosses a certain threshold. Earlier it was 50 lakhs and now it is 1 crore from the last assessment year. I mean the assessment year 25-26. So depending on the assessment year that we are talking about, Schedule FA works very differently. There is no income threshold. If you are ROR and you hold foreign assets, disclosure is mandatory even if your income is below 1 crore or even below the basic exemption limit of 2.5 lakhs. Even then you need to disclose. So in short, domestic assets, the disclosure is linked to income. But whereas for foreign assets, the disclosure is linked to residential status. That structural difference is why Schedule FA feels more penal. What are the typical disclosures under Schedule FA? Schedule FA covers a wide range of items, all types of financial interests such as overseas bank or custodial accounts, foreign equity, ESOPs, RSUs, overseas pension accounts, foreign insurance policies, immovable property situated outside India, or even if you are a signing authority in any of the foreign accounts, and interest in foreign trusts or entities, or even if you are a nominee for some of the insurance policies. So why was Schedule FA introduced first of all? Schedule FA did not appear randomly. It was introduced alongside the Black Money Act of 2015. Schedule FA is the reporting mechanism. The Black Money Act is the enforcement law. This connection explains why even small disclosure errors can later feel very serious. The Black Money Act applies to undisclosed foreign income and assets. It is separate law from the Income Tax Act. It has a much stricter penalty framework. That is why Schedule FA carries a high stakes perception. Not because everyone is guilty, but because the law behind it is very strict. Now let's understand the penalties under the Black Money Act. Under section 43, there can be a penalty of 10 lakh per undisclosed foreign asset, or even if there is a mistake in reporting. This applies even if the asset does not earn any income or the tax has already been paid elsewhere. For example, ESOP, perquisite tax. And the penalty is asset specific, not return specific. This is why accuracy in disclosure matters so much. So with all this, is there any threshold relief? Historically, there was a 5 lakh threshold relief, but this was not a blanket exemption at all. It largely applied to small foreign bank balances or salary linked or dormant accounts, which you would have forgotten while coming back, and it was never meant to cover all foreign assets. But under the current framework applicable from 1st of October 2024, the threshold has been increased to 20 lakh, applicable to the aggregate value of movable foreign assets measured at any time during the year. So if all your assets during the year are lesser than 20 lakhs, all foreign movable assets, then only you get this special exemption. Now foreign immovable property is excluded here. Which threshold applies depends on the assessment year involved, and this is for the penalty. Now exposure under the Income Tax Act. What happens if you have not disclosed under the Income Tax Act? This was all about the Black Money Act. Now what will happen if you have not filed the Schedule FA under the Income Tax Act? Even where the Black Money Act is not invoked, the Income Tax Act can still apply, simply because you have not filed all the correct details in ITR. So it is misreporting or underreporting. This can mean scrutiny or reassessment, reconciliation of foreign assets, penalties for underreporting or misreporting. Often the time, cost and stress are much higher than the tax involved. So why issues are surfacing now? The biggest reason is automatic exchange of information. Through CRS, FATCA and treaty-based information sharing agreements, the data is flowing across borders freely now. This is not guesswork anymore, it is data-driven matching. Technology is a double-edged sword. India processes a massive number of returns, 8 crore plus to be precise, using analytics. That improves efficiency, but it also means mismatches are detected faster. Incomplete disclosures are no longer invisible. Such reporting is not unique to India. This is not an Indian only issue. Mature tax jurisdictions like the US, UK, Australia, Canada all expect global asset transparency for residents. As data access improves, compliance expectations rise. This is a global trend. Now, why does Schedule FA feel complex? Schedule FA is granular by design. It requires asset-wise and country-wise reporting, distinction between ownership and signing authority, peak and closing balance during the year, correct classification of accounts. This is where genuine errors happen. There is also a big confusion around the calendar year versus financial year reporting. Schedule FA disclosure refers to calendar year positions, that is Jan to December, while income reporting follows the financial year, that is April to March, as per the income tax return. So any income that you derive has to be reported from April to March, but the position will remain for the last calendar year. So reconciling the two needs care, and those 15-month data needs to be carefully analyzed. Another point is the ESOPs and RSUs, the common gap. This is most common misunderstanding, that since tax is deducted at vesting as a perquisite, I don't need to disclose, but payment of tax does not complete disclosure. If you continue to hold foreign shares and you are ROR, disclosure is still required. Other commonly missed foreign assets. Many issues arise from overseas salary accounts left open, foreign pension accounts that cannot be touched till your retirement, or reinvested dividend or preference instruments, assets forgotten after returning to India. The system does not forget what we forget. So here global investing is not the issue. Investing abroad through authorized channels is perfectly legal. There is no presumption of wrongdoing, The focus is only on accurate and complete disclosure. There is also a role of platforms and employers. Many platforms already provide asset-wise reports which are relevant for Schedule FA reporting. Employers already have the ESOP data with them. A structured annexure with Form 16 could reduce a lot of errors. So this is more of a system issue, not a blame game. Now, what to do if you receive a communication? First, confirm your residential status, calculate the number of days correctly. Then identify whether there is a disclosure gap. It is there only if you are a ROR, otherwise no need to disclose Schedule FA. Now, if permitted, file a revised return. Revised return can be filed only till 31st December of the next, the subsequent year, I mean the assessment year. An updated return can be filed for the last 4 years, but that can be filed only if you have any additional outflow of tax. So that has to be checked properly. If there is any tax liability, then yes, you can go ahead and file a ITRU, which is the updated return, which can go backdated for the last 4 years as well. Otherwise, address the issue through assessment proceedings calmly and systematically. Schedule FA is not new. NR and RNOR are clearly excluded. For RORs, foreign disclosure discipline is essential in a transparent, data-driven world. Proactive compliance is always easier than reactive defense.